Welcome to this episode number 82 of Your Next Trade, called today Trump 2-0. So 4 more years we're gonna have Trump won by a huge margin on Tuesday evening, Wednesday morning. The market, as we saw over the last few weeks, was expecting Trump to be winning. Having said that, the positioning was pretty much reduced, and what we saw on Wednesday is a massive move across asset classes. So we're going to be going through what happened this week. We're going to be talking about what could be happening in the near future. We're going to be going through different ideas, trades that I think could be interesting. But let's go through first about what has been happening in terms of week-to-date asset performances, starting with the left-hand side with stocks, with the S&P up 4.7%. So that is the best week in 2024 for the S&P. And we get the Russell 2000 up 8.6%. As we're going to see later, it's pretty much the same playbook as it was in 2016 with some differences, but the picture is roughly the same. In terms of Europe was weak, down 1.5% for the Euro stocks. Japan strong. Interestingly as well, the dollar was strong. So if you think about stocks over those different regions, we have US doing up 5 to 8%, Europe down 2%, but if you take into account the currencies, the euro dollar down 1% on the week, you had more underperformance of Europe. Bitcoin very, very strong, so the crypto world very, very strong. The reason has been pretty obvious with the endorsement of the Trump administration of the crypto space, saying that they're going to be buying some reserves. So the whole space has been pretty strong. We could underline as well, like the tech bros that have been putting a lot of money through the Trump administration and pushing for Trump to be winning. The crypto world has been really keen on putting money at work to make sure that Trump was winning. So what they had is what they deserve. So if we look at the week-to-date industry performance, and this one is interesting. So the solar one, so that was a trade that I called, I think it was a couple of weeks ago, where I said you could be long, not you should be long. You could be long tan out of the money, call spreads if you think that Kamala Harris will be winning. That was, I was pretty clear that was a lotto ticket, meaning that the odds were really, really low because the market again was pricing Trump winning, but it was mostly having a huge winning factor. We are talking a 30 to 1 if it was happening. The position was really, really small. So for me, that was more, I don't want to be most involved into going into the election with a lot of positions. So I reduced positions, and I just wanted to be playing the outlier, which was the Kamala Harris winning in that case. Didn't play out. Just before the election, the call spread was up 100%. As of yesterday, is down 60% something, but very, very small. What was more interested is to be making money trading on that day. And I made, to be honest, 100 times more than what I put as a trade. And what I learned from 2016 is you don't want to go big into the election. So if you got any indicators telling you, for those events, you should be having position and a lot of gross exposure. And in the meantime, they're telling you, don't play the NFP, don't play the earnings. There is an absolute mismatch. So what has been pretty obvious into this week is, so you got the S&P here, but you got really some huge winners. We are talking 10% on the week with the banks, regional banks, the banks, the Russell 2008%, and most of this performance happened, on Wednesday onward. So Wednesday banks were up 10%, and we had some follow-up. So really big moves. If we look at the sector performance here on the weekly basis, this is exactly the same picture, where consumer discretionary, obviously with Tesla, has been helping, but everything has been going pretty well. Having said that, if you look at anything that is materials, a bit of a struggle, healthcare, a bit of a struggle, and to be honest, let's put that under the scenario here that we have a 5% plus move. Consumer staples, defensive as well, not doing as good as the other sectors. So in terms of rates, so now we are at 4.31% on the 10 years. We went to 440, 450. So the expectations, if you look at the US 10 years, we had a big move of 60, 70 bips, 0.6 to 0.7% over the last couple of months. Why? Because the Trump administration is not going to be any magician. So when you get a new administration, they are telling you that there's going to be a lot of growth, that they're going to be cutting taxes, and in the meantime that the deficit is going to be under control. So guess what? It's almost impossible. If you put tariffs, if you're running a lot of expenses because you want to finance new businesses, that means something has to give. And what the bond market is telling you is the deficit is not going to be coming lower anytime soon. What is interesting is if you look at the Republicans, what they have been saying, many of them are now saying, we should be having a huge growth to be able to pay back the debt, which will be a perfect scenario, and I would be very glad if that happens. But it's more or less the same playbook that the Democrats have been using over the last 4 years and Trump before, which is the MMT, the modern monetary theory, where you're going to be printing a lot of debt to financing the growth. Having said that, the growth is still way lower than where your deficit is running. So if you get a 3% GDP growth and a 7% deficit, there is still a 4% mismatch, and that is the issue. So I think for stocks, for any assets, what we should be really keeping an eye on is the bond market. But for the time being, this is about deregulation. This is about more growth coming into 2025, about the possibility of the Trump administration of delaying the stop of the tax cuts that should be happening at the end of 2025, which was a big reason why EPS did very well in 2017 and 2018. So what about the Fed expectations? So for today, I use the CME website and looking at what are the expectations. So it's 2/3 for a cut, 1/3 for standstill. We got the FOMC meeting on Thursday, so normally it's on Wednesday, but because of the election, that was on Thursday. And what the Fed has been saying is they're going to be doing the same as before. So far, as long as inflation is coming down and going into the 2% target, that is fine on the inflation side. If you look at the other side of the mandate, which is the job market, they have been clearly saying that the job market has been weakening, and that is the biggest reason for them to be cutting rates. So market is expecting 2/3 cut of 25 bips in December. We're going to see how the next jobs market jobs data are going to be, but the odds are for the time being for 25 bips cuts. What about the volatility? So after the election, guess what? Volatility went from 22% to 15% because first thing first, the most of the options were pricing for Tuesday and Wednesday, and then after that, based on the outcome of the election, it came down. This is the same here for the 9 days VIX. So volatility coming down quite nicely. We are now below the 15%, and we are back to the levels that we had before the election. But those are the levels again where the market is probably going into, which are the 12% level for the volatility. The term structure, we are back to the normal term structure for the VIX. So let's jump quickly now into the technical analysis, starting with the S&P future. So the trend that we have been putting on for the last few months is still the same. Now we are at 6,000 on the S&P, so you could be putting your 6,000 S&P hat. The trend is we are going at the top of this range, so I'm targeting 60, 80 something. We're gonna see later what have been over the last 25 years the seasonality, the Nasdaq making new high. So really most of the indexes 5% plus moves, and this is the Russell is really the big winner. So the playbook is exactly the same as 2016, and actually for most presidential election, this is something that we flagged on the Discord community for the most advanced channels. Most of the time after the elections, for the next 3 months, Russell 2000, meaning small and mid caps in the US, are outperforming the overall market. The expectations are for the Trump administration to be pro US companies, meaning that the 2000, the company, the small and mid companies will be benefiting a lot. If you think about the S&P 500, this is 50% into the US and 50% non-US. So what are the calls that we are starting to be saying? And you should be taking a pinch of salt, but this is for your RD generation, that actually the S&P equal weighted could start to be doing well versus the S&P. So this is one of the things that I'll be watching. What about looking at the gold that has been coming down a bit for the week? So we went up almost to 2800. We gave back some performance. The playbook, again, same as 2016, where gold gave I think 3 to 5%, then bounced the months later. Euro dollar, so strong dollar across currencies. So if you look at the euro dollar, I think this is a chart really to be that is very interesting. There are good chances that now we could be targeting 105 in the very next weeks. What we see from most commentators will be that we should be expecting a strong dollar going forward with a strong Trump administration. If you look at what happened in 2016, actually, one of the very few first thing that the Trump was saying is he doesn't want a strong dollar. So we got the macro versus what Trump will try to be making. He will probably be making some calls and saying, dollar is too strong versus the euro. The Chinese yuan is too weak, and that means that's going to be part of this policy that is going to be using to justify or not tariffs. Some other charts that I want to be underlining for this week. So looking at the KB, looking at banks. So you see we had I don't know, for those of you, some of you will be looking at for cup and handles, but we had this breakout and really this gap on Wednesday after many years of not doing much. Why? Because the market is expecting huge deregulation, and that should benefit mostly the banks and the regional banks. So if you look about a bit of fundamentals, what you see is most of the banks, will be trading in the US above their price to book, above their book, sorry. And, some, if you look at history now, the regional banks, in the past, where it was, when we had some deregulation, we are talking more than 2 times a book, so you could be targeting 2.5 to 2.8 book value, and those are for the ones that are looking at banks and understand a bit of what I'm talking. Looking at crypto, I think it's easier for everyone. So crypto making new highs now. That the push is the same as we had not that long ago, but the 6,000 for the S&P. Now people are saying, we had 75,000 on the Bitcoin, with the Trump administration being so friendly with Bitcoin. We should be targeting 100,000 for the end of the year. So a space to be looking at. And finally, for the fantastic Elon Musk and the way he managed to push Trump win and help the win, not only by changing the Twitter and suggesting you for you to have only news dedicated to Trump. This is, one of the rewards was with Tesla, as we're going to be looking later on. But, DXYZ, which is an ETF that is invested mostly in this SpaceX and going to Mars. And as you can see, over the last 3 sessions, we have been trading like crazy volumes, and we went from roughly $11 to $36 on the close. So if you look at an ETF, especially at a closed-end fund like this one, we are talking that there is an NAV. What is an NAV? That is, what are the asset worth? And the asset worth roughly are worth $6 as of these days. So, 3 days ago, the market was paying 100% premium to those assets of SpaceX, and now the market is paying 6 times those assets. In other words, you can see the frenzy around Elon Musk and all his assets. So let's go back into the Excel and looking at what happened for the week. So let's start with China. So China had their all big meeting, Politburo meeting from Monday to Friday, and the expectations were for strong stimulus. The reality is they are just switching some bad debt into the balance sheet of the Politburo China. So the expectations were pretty good, and actually they delivered not that great. So what we saw, and this is one of the reasons that Europe as well was weak, because Europe is the second derivative of China, and a lot of companies will be exporting to China. So for example, European luxury yesterday on Friday was down 3%. Why? Because it's pretty obvious that it's going to be taking time from China to be restarting the economy. So US elections, and this one is important because obviously that was the biggest factor of the week. So we saw, so that is on Tuesday, these are the election, and then overnight we started to move, and then we ramp up. So first thing first, this move, which is, when we open on Wednesday, and I want to underline this one, so the 2024 versus 2016, Playbook. So I did a Substack. I'm going to be putting the link into below here on YouTube. But what is it about? It is about understanding what happened in 2016 and what happened over the last 3 days. And the picture is pretty much clear. So if you look at the ETFs, if you look at financial, if you look at the Russell energy towards real estate, and if you compare in blue the 2024 versus 2016, the playbook is exactly the same. You do have like a bit of difference with healthcare, and I think it's technology. But other than that, most sectors have performed the way they performed in 2016, with the caveat is the moves were much bigger. So instead of talking about 1 to 2 standard deviation, we are talking to 3 to 5 standard deviation move. So really, really big move over the last few days, and especially on Wednesday. And after that, from Thursday onwards, what we have is literally the grinding higher, which is mostly explained by new inflows. So we had tons of inflows on Wednesday. So I strongly advise you to check the ETFs inflows that we had on Wednesday in terms of KBE, KRE, and some sectors. But after that, it was mostly inflows and options. So with options, we saw before that a lot of protection of the market was on the left-hand side with a lot of puts, and now we are grinding higher. So we are back to the playbook of, you remember or not, 2021, 2022, where you buy calls and those calls are kicking in, and the gamma, the delta makes the market maker buying and buying and buying slowly but surely. This is what we had on Thursday. This is what we had on Friday. And on top of that, you had the big crazy calls that will be targeted into very few names, or actually many names now. So Tesla is a very good example here. As you can see, so Tesla is above 300 and managed to go from 250 to 320 very quickly. But what we see, so this is your green here, so that will be for the calls. And on Friday, especially because this is the weekly expiry, and the Friday, the weekly calls become, 0 day to expiry. And we had more than 4 million, almost 5 million calls that were traded on Tesla. And that explained a big move on the Tesla name. So in other words, what we're going to be targeting in terms of ID generation, you don't need to be smart. You just need to have your tools ready, and this is going to be where market participants, where you're going to have people buying tons of calls on the day or in the next few days, because that's going to be having an impact. So in terms of catalysts, I want to flag those one. So we're going to have the CPI and the PPI on Thursday. So this is for the macro. We know that inflation has been coming down. We know that most recently the market has been trading okay with inflation. going forward in 3 to 6 months, if the market and if the Trump administration is really pushing growth again, there are good chances that inflation will come back. So that is something to keep an eye. For the time being, market is kind of hawkish, but when market is pricing less of a fear of inflation, you do know that actually it could come back. Retail sales on Friday. Obviously, the picture is not ideal because this is pre-election. We are going into a very important time now for retail space. Why? Because we're going to have Thanksgiving, Christmas. So very, very important. And as you know, the US consumer is making 80% of the US economy. This is very important time in terms of macro. So CPI, PPI, this is done. Retail sales is done. Earnings, we had some huge moves. As I said, names like APP and some others where we saw stocks, 50, 100%, names that we flag, bros in the US, obviously. So really, really big move. So what we have is the realized moves when you are beating, when the expectations have been pretty low. If you look at Upstart, for example, UPST, huge move. We are talking 40, 50%. So this is something that really the market is going back full in steroids in terms of calls and buying those calls. I want to flag as well that we're going to have Powell talking on Thursday. We're still going to have some earnings ongoing with Home Depot, for example. We're going to have Cisco, we're going to have Disney. But the biggest one that the market is waiting is for NVIDIA, and that will be in 10 days' time, and Walmart as well. So that will be on the 20th of November, I think. And this is the next big driver for earnings going forward. But I want to suggest for you to be looking at those big catalysts going forward, because obviously with the Trump administration, that means the expectations are for big changes in terms of tariffs. First, tariffs versus China, maybe 60% versus Europe. So that means in terms of your big ETF allocation, country by country, tariffs is very important. Reshoring, why? Because, US administration and before Biden has been saying, we're going to be reshoring, we're going to be taking back some of the production that is in the US, that is in Asia back to China, to the US. So the reshoring, we are talking semiconductors, we are talking auto, we are talking, anything that is industrial. And if you look at one of the topics that the Trump administration has been saying pretty much is they're going to be looking at Mexico as well. And this is why you get names like Stellantis, for example, that have been struggling. So this is for your tariffs and your reshoring. Another one is deregulation. So deregulation, it's not only for banks, which could be benefit from it, but it's going to be as well around healthcare. It's going to be about, remortgage. So a lot of industries could be impacted. And don't get me wrong, but the mandate that Trump is having these days is pretty big, and pretty is an understatement. Why? Because he won by a huge margin, meaning that he's going to have the backing of doing some changes and deregulation. So plus, we do know that many tech bros have been helping him, winning this election. We are talking Musk and some others. So they will be very keen, guess what, on having some of these businesses from governments going from public to private. So one of the, if I want to be sarcastic, the funny thing is most of those tech bros, if you look at Palantir, is making more than 50% through governments. So even if they are saying, this is for the best of the governments, yeah, that is true. But, one of the reasons that they are doing so well, and that's the same with Tesla, is because they received money from the governments through the CO2 emission. So don't get confused here. There's going to be a lot of changes through deregulation, a lot of ID generation, looking at ETFs, looking at single names, and as well, energy is a big theme for the next 5 years because of the constraint put on the electricity system, and as well with the artificial intelligence AI demanding so much energy, it's going to be needed to have some changes. So we are talking nuclear, we are talking, what is the energy coming from. So in terms of the the volatility going forward expectations. We went from 2.8% expected for this week, and actually we moved by 4.6%. So we move almost 2 times more that was the straddle was expecting. So for this week, being long straddle was extremely successful. You do know that when volatility started to get smashed, then actually, something that we had in 2023, the playbook was smashing the straddle, being short straddle. So let's see what the market is going to do. For this week, we are expecting 1.2% plus or minus move. So, and finally, in terms of seasonality, so this is the seasonality. Yellow one is the 2016 yellow playbook that we had, where the market between the 8th of November and the end of December, end of the year, was up 4.6%. But overall, the market is up 2.5% between roughly the 10th of November and the end of the year. So very positive end of seasonality going forward. We are talking between 2 to 5%. So we got many good drivers. In terms of valuation, I can still say you the same thing. We are trading 22 times earnings for 2025 now. So pretty demanding market. So unless you got a strong growth restarting, we already got 3%, but even better than that. So many expectations. I would not be fighting that trend. We don't have any signal for the time being. It's hoo-ha-ha. This is election. Everyone is clapping, and we got the strong flows and strong moves into calls, for example, those calls that are going into some names. So this is it for me for this week. So as I said, looking at the past week, for me, it was a good trading week. I had a good Thursday. I had a very good Wednesday, actually, trading in Europe mostly, where we saw some very interesting trade. So I did 3 big trades. I did one on an Italian bank. I did one on that was wind in Denmark. And my third one was defensive, trading defense in Europe. So overall, what I tell you is going forward, we got good seasonality. We're gonna have a lot of deregulation, a lot of expectations. So let's see what the near future brings. If you want to learn more about what I do with the 4x4 video series or the mentoring, or if you want to join the Discord community, you can send me an email at greg@duponttrading.com. And as always, I try to answer your questions as quickly as possible. So this is it for me for this week. Have a good trading week. Bye-bye.